Hi, I'm Scott Shelley here in the Seymour Group floors in Chicago. This time, yes, Chicago for some good pizza, finally, in from London. But here for Traders Exclusive. And really, what I've been doing lately, and I've gotten some decent responses, I'd like to talk about what I've been asked to talk about. Really, that's kind of the segment. And lately, it's been bonds, it's been emerging markets, obviously the trade, the tariff tantrum that we're seeing take place. But really, it's been mostly about the emerging markets. And let's go through the numbers real quick, not to bore anybody, but we're definitely in a bear market there. It's the longest downturn we've had in those emerging markets since the financial crisis. For the stock market, it's been about, for the emerging market stocks, it's been about 222 days, not including today, 150 days for their currencies, and 240 days in a down market for their bonds or currency-related bonds. So not good. And the reason why that's not good is, number one, these things that take a long time, not the short, sharp downsides, but the ones that take a long time take up a lot of capital. There's positions that can't be unwound too well. And so we start to move from this buy the dip scenario to maybe even sell the rally scenario, and then once we get from there, we move into this general contagion. Now, I think that's too big of a word to talk about right now, but it's definitely something we have to worry about, because you know what? Look at the manufacturing numbers that came out of the U.S. yesterday. That didn't add any help to things, because it's just making the U.S. stronger, making their currencies weaker. They've got debts to pay in their currencies, which means they have to pay more, and we can see this story play out. So it's still considered pretty serious. Today, their stocks went through that 20% level from a recent high, so technically it's what we would say is in a bear market. I think we all knew that already, but just something to really keep an eye on, because it's taken so long. It's now the longest one again since the financial crisis. And the only other thing I'd like to say that's kind of interesting, because we're kind of smack dab in the middle between 2.75 and 3 is the 10-year yield here in the States. And there's been a lot of folks on one side of that boat thinking that, hey, the U.S. economy is doing well, we're going to have to raise rates. They're short bonds in the hopes that they see those yields go up. Well, it hasn't really worked out, has it? See, we've traded down as low and around that 285 level, but we're basically in between 275 and 3. And with so many folks on one side of the boat, it just doesn't tend to, A, turn out like you think it's going to, and B, we've all forgotten that there is the rest of the world out there, and what has been extraordinary central bank measures have now become ordinary. And what I mean by that is the Bank of Japan and the European Central Bank still printing such free money. That free money has a cap on our yields here in the States, something to keep an eye on. That's been confounding a lot of folks. Remember, extraordinary is now ordinary. That's it from me for Traders Exclusive. I'm Scott Shelley here in Chicago, almost in London. I'll let you know how the pizza tastes, but I'm glad to be back. See you next week.